This is the Wall Street for Main Street radio podcast, your number one destination for financial news, information, and education with no strings attached. Be sure to check out our other podcasts and articles at www.wallstreetformainstreet.com. Now, here are your hosts, Jason Burek, Mo Dawood, and John Manfreda.
Hello, everyone. Welcome to Wall Street from Main Street podcast. I'm Mo Dawood, and today's special guest is a returning guest, Jason Kelly. Jason Kelly, the editor of the Kelly Letter, and he recently put out a new book called The 3% Signal. Jason, thank you for joining us.
My pleasure. Glad to be back, Mo.
Yeah, Jason, I was talking to you before the podcast. You were actually my first podcast guest when I started doing the Wall Street from Main Street podcast, so it's great to have you back.
Yeah, it's good to be back. Nice history there, although our very first one was in the wake of the 2011 tsunami in Japan, so I'm glad we're speaking now in better times.
Oh, I agree. We'll talk a little bit about that in this podcast. I want to start off the podcast by talking about your background. For people that don't know much about you, for our listeners, tell us what your background is and how you got involved in investing, because I read up about your background, and you majored in English, and it doesn't seem like you went to Wall Street or any of the other career paths that other people we have interviewed. So you have a very unique background. Why don't you talk about that?
I studied English literature at the University of Colorado, and during that time I was also studying on my own on the side and investing in order to help family members with retirement accounts and college funding and other long-term goals. It was just fascinating to me. So it started as a hobby, really. And as a college student, I was excited that I could get investment literature for free by calling the various mutual fund companies, and they'd send me prospectuses and booklets, and so my dorm room filled up with material on investing. And then out of school, my job was as a technical writer at IBM's Silicon Valley laboratory in California. And that experience honed my writing skills to make me good at writing about complex topics and making them easy to understand and enjoyable, I think. It really set me up to bring the two parts together, my hobby of investing to help family and my ability to write about complicated topics. So I started writing about investing on the side while I was working as a full-time tech writer at the Silicon Valley lab. My first book was about mutual funds. It was called The Neatest Little Guide to Mutual Fund Investing, and it did very well. It was published by Plume in New York, and it caught on because it has a conversational tone to it. And I had really gotten started in the field by telling family members who don't know anything about investing, and the key was didn't want to know anything about investing, how mutual funds work and how they could set up a plan that would grow wealth over time without creating a lot of stress in their lives. And I was used to explaining to people that don't have any knowledge or want any knowledge the basics of how this works. So not a lot of jargon, not a lot of complicated sidebars and so on. That was the tradition that started me in the field, and it became my full-time career. When my writing about the stock market and the economy produced income that matched my income at IBM, I was able to step gracefully away from the company and become a full-time writer, and my subject remained investing in the economy. That was about 20 years ago. And by the way, I should add that my experience at IBM was great. I wasn't one of these people that was leaving in a huff or upset or anything. It was fantastic. I was really pleased that the company was giving people like me, liberal arts majors with a background in writing and literature, a shot in a technical field. And I thought IBM's philosophy was great. They said we can teach non-technical people the technical side of this business, but we cannot teach the technical people how to communicate well. I thought that was a nice way to turn things on their heads and give the more artistic sensibilities a chance in the technical field. So with all good feelings toward IBM, I stepped off and became a full-time freelancer. And like I said, that was about 20 years ago. In that 20 years, I spent a lot of time looking for the perfect evergreen investment strategy that anybody could use in a 401k or other IRA or other long-term retirement account or any other long-term investment goal. And this latest book that you mentioned, The 3% Signal, is the culmination of that effort. My best-selling book so far has been The Neatest Little Guide to Stock Market Investing. which is a very good book. It's a good backgrounder on everything somebody needs to know to get started in the stock market, with some good looks at different basic strategies like value and growth investing, some charting basics, and just so somebody can survive a discussion about the stock market and kick things off. But from feedback I received, I realized over the years that book's now in its 5th edition, and I realized over the editions that people are still shooting themselves in the foot in the market. They're making all the wrong calls. They're getting advice from the wrong areas. They're just going wrong in these long-term goals, and they still need a simpler framework, something that is tried and true, that kind of behind the scenes brings together the best practices of long-term stock market investing in a way that people who don't want to become experts can run. And that's what this book is all about, and I'm really proud of it. It's the culmination of 20 years of work.
And that's an interesting background. And what I like about your background is that you haven't gone to the, like I said before, the normal career path of, going to Wall Street and then leaving and starting your own thing. You never even touched foot on Wall Street. So you started your own thing. You end up working at IBM out in the West Coast in Silicon Valley, and here you are now writing about investing. What I like about you, like you said, that you take things that are complex and simplify them for people. So
yeah, one of the things that I believe has gone wrong with the economy is this notion that people who have no interest or aptitude for finance are expected to manage their lifetime nest egg investing. It didn't used to be that way. I mean, the good old days of pensions, somebody could work at a company for their whole career, and at the end they'd retire with plenty of money to take care of them because the company shouldered all the risk of managing the pension fund, which makes sense for somebody who's riveting metal or teaching students or doing something totally unrelated to finance, works hard their whole lives, and then expects to retire. Well, these days, we expect everybody, whether they're in finance or not, to manage a 401k in a way that makes sense, and it's just not practical in my view. I don't know why people think that's okay. We don't expect people to do their own health care or home construction and other things that require a lot of skill. Why do we expect the complicated field of finance to be something anybody can handle on their own? So, yeah, this is the kind of plan that people need who are forced to manage their future without having the aptitude for it.
I don't think anybody has talked about this, but I think we are currently in a retirement or going to be in a retirement crisis where people don't have enough money saved up or invested to retire due to high inflation, high taxation, unemployment, and just the fact that people don't know how to invest as well. And like you said, like 50 years ago, people had pension. They didn't have to worry about that much about investing and trying to save for retirement. But now we have 401ks, which proved to be ineffective for the most part, for most people. We have IRAs, but a lot of people don't know how to allocate their asset efficiently and correctly.
That's right.
So I think we are currently going to be in a retirement crisis for a lot of people, especially baby boomers, because of that.
Yes, there's no doubt about it. People are improperly allocated everywhere. And the basic mistake people are making in most cases is taking too little risk in the market. They're afraid of the next crash. They're told constantly by the media that the next crash is around the corner. And the fact is, crashes are rare. Despite the fact that we've had 2 of them in the last 15 years, the dot-com crash and then the subprime mortgage crash, those are rare. And in both cases, there was a sharp recovery. In both cases, the thing to do was to invest into the bottom or through it. But people don't do that. And it's unreasonable to expect that they will without some kind of framework to help them stay the course, something that shows them this is what to do, don't give it a lot of thought, tune out the media and the noise, and just keep this plan on track and you will be fine. That's what people need because, they're given a 401k list of maybe 20 or 30 funds. They have no idea what to do with that. So what they end up doing is a broad diversification of maybe 5 or 10 different funds. So they own some stocks, some bonds, some overseas indexes, this and that. And it ends up being a middling result that returns less than the S&P 500. And they still crash when the market goes down, and then they get off to the sidelines, just like we've seen most recently. For 5 years, some people have been sitting in all cash or bond funds. And it's not their fault. This is not their thing. It's like blaming somebody for not knowing how to change the oil in their car. I mean, yeah, some people can do that and know how to do that, but why would we expect everybody to be able to do that? And so you're right, there is a retirement crisis on the horizon because people have been tossed into the open sea of investment choices without any education on the background of it, and companies don't take care of them that way. In fact, it's the opposite. People are competing against the Wall Street crowd because that crowd wants to skim fees and profits off their retirement accounts. It's a terrible situation. I really hope this book helps a few people at least get on the right track.
I agree. So right now you live in Japan, and we're talking from Japan. So I want to get your insight on the Japanese economy because a lot of stuff going on there. So tell us your thoughts on the Japanese economy after Prime Minister Abe implemented a massive stimulus program last October. What's been going on in the economy over there?
Yes, the Shinzo Abe administration has been very active, and that's his last name, Abe, gives rise to the term Abenomics, which is his attempt to get the country back on track. What Japan's been fighting for more than a decade is deflation. The problem is really that the population isn't growing anymore. It's shrinking, in fact. And that's what I think is left out of the discussion a lot. Abenomics is supposed to be 3 arrows in the quiver. It's supposed to be monetary reform with the Bank of Japan, and it's supposed to be tax reform and fiscal reform, meaning the way the government spends money and structures companies and manages companies, the interface between the government and companies. And then the tax reform is supposed to increase taxes as a way to take care of the government debt so we don't have the Japanese government bond crisis everybody's been worried about for, 15 years now, I think. How's it going? Well, honestly, 2 of the arrows in the quiver don't matter at all. The fiscal reforms are dead in the water. The tax reform has been a dud. The sales taxes have gone from 5% to 8%. They're supposed to go to 10%, but going from 5 to 8 caused a mini recession, so now they're backing off from 10. So really the only thing that's stimulating at all, like everywhere else in the world, is the central bank. So it's the pumping of yen into the economy that has greatly weakened the yen. It went from 80 yen per dollar a couple years ago to 120 yen per dollar now. So that's a strengthening of the dollar, weakening of the yen, which helps Japanese exporters. So the stock market is doing well. Just a little background on that. When Toyota makes a car and sells it overseas, when it can bring back dollars, for example, from America, having sold a car in Los Angeles, let's say, when the yen is weak, when those dollars come back to Japan, it turns into a lot of yen profit for the company. So it can report growing profits thanks to that weak yen, even if the profits on the car didn't increase all that much. That, in short, is why a weak local currency helps these exporters. Well, Japan's an island country, so there's not a lot of local resource and not a huge domestic market. It's always been an export-driven economy. That's really the whole story. It's not the story you'll get in media. You'll hear about all 3 quivers working, how Japan is really undertaking reforms and trying to get women better leadership roles and a lot of stuff like that, which in my opinion is not the case at all. The only stimulus taking place is from the Bank of Japan in the form of the same thing you see from the Federal Reserve and the European Central Bank. They're buying bonds, they're buying assets, they're injecting currency into the market, and that's what's going on here. So that's why we saw the Nikkei 225 go over 20,000 last Friday for the first time in 15 years. A lot of things that are happening for the first time in 10 or 15 years around here. That one, a couple things to keep in mind for people that are really interested in investing in Japan. The Nikkei 225 is a price-weighted index like the Dow Jones Industrial Average. It's not a market cap-weighted index. So what this means is that a stock that goes up a lot in price gets an increasingly large influence or allocation within the index, which leads to bizarre distortions. For example, right now, there is a single stock that accounts for almost 10% of the Nikkei 225 index. Now, you would think, being Japan, well, that must be one of the marquee companies such as Toyota or Nissan or Canon, Sony, one of those kind of big-name brands. But in fact, it's a company called Fast Retailing that has clothing shops called Uniqlo, which are very good, and another brand called Theory. Now, these are global brands, and it's a good company, but 10% of the national stock index is way too much of an allocation to a clothing retailer. So you get some bizarre distortions like that going on in the Nikkei 225. And in my opinion, the whole reason the stock market is rising is due to that central bank stimulus, as we've seen in other countries. Very quickly, as for the man on the street or the woman on the street, the so-called Mrs. Watanabe at home, life is not much different, but it never has been much different. I've lived here for 13 years now, and during that time we've had recessions and growth periods, and life never changes much. It goes on pretty much the same. Almost the entire country is a middle class. So you're not seeing anything like a big stock market frenzy. Nobody's in a panic to own stocks. And I don't know anybody here who owns stocks personally. That's all just pension funds and insurance policies. So it doesn't look like Shanghai these days, where there's a bubble building and things are overheating and high schoolers are trading stocks. It's not like that at all. In fact, you and I guess just I have spoken more about the Japanese stock market and economy than I've heard any of the people I know in Japan, who are Japanese, speak about it in the last year. It's just not a topic of daily conversation, and frankly, I speak more about the Japanese stock market with foreigners than with Japanese people.
And I've never been to Japan, but from what I heard, a lot of the Japanese are very conservative investors. So they have pensions, insurance, like you said, and also they invest in the Japanese bond as well.
Yes, that's correct, and that's one of the reasons that the bond market's been able to go as far as it has. Is that Japanese people will follow the lead that's given to them by the government. And if the government says buy Japanese bonds, they will. That doesn't work in other countries. If Americans were told buy treasuries, you must buy treasuries, you can imagine the discussion that would follow. My gosh, why do we have to buy treasuries? Why is the government in a panic? That kind of thing. But in Japan, people pretty much do what they're told, and they are conservative investors. I would say they're basically non-stock investors. There's a little bit of a growing interest in young people in the stock market, and that's because they weren't active back when it crashed in 1989 and 90. That's a long time ago. It's more than a generation ago now. So people who are in their 20s now think, hey, stock market, not bad, going over 20,000. They're getting more interested in it. So we may see a revival in stock market investing in Japan, but for the most part, your impression is correct. Japanese people are not stock investors, and they're really not investors at all. They're amazing savers, but they're just not investors in the sense that we think of that word.
So there's no concern among Japanese regarding the bond market in Japan, because a lot of people here in the U.S., especially Kyle Bass, is betting on a collapse in the bond market. Yeah,
that fear has been around so long. It's kind of like the fear that the world is going to end or something. It's one of those things that's just always out there, but never really happens. People have been talking about the collapsing Japanese bond market since 1988. Since 1998. It just doesn't happen. It's gone so far beyond what anybody thought was possible. People were in a panic when Japanese debt to GDP hit 100%. It was like, well, this is no good. You're hearing similar talk like that in America. If it gets to 100%, we're in trouble. Yeah, maybe. In Japan, it went to 100%, and people freaked out. It went to 150. They freaked out. It went to 175. It was like, my gosh, we've never seen this before. Got to 200%, and it was like, oh, we're going to hit the end any day now. Well, we're at 230% plus now, and have been for a while. Life goes on. It's totally normal. It's not bankrupt here yet, and people are now excited about the Japanese stock market. So, and this, eventually, when we talk about my new book, remember this discussion, because everybody has been wrong about the Japanese government bond market forever. That's why it's called the widowmaker trade, because they've been calling for it to collapse for so long that anybody betting on the downside has died in the market. So it's called the widowmaker trade. And yeah, so nobody here is worried. Well, not nobody. Somebody's worried about the Japanese bond market, but the ordinary person doesn't know anything about it. The people that do think about it have kind of given up guessing when it's going to collapse, and you can find a tiny percentage of people that are still waving red flags and saying it's going to all come down at any moment now, but you always have that group.
So let's talk about the inflation in Japan. After they implemented the stimulus program, how bad is inflation in Japan? Because I'm looking up the chart for the yen, and it got killed compared to the U.S. dollar. Right now, it's hovering around 121. Yeah. So, inflation in Japan bad, or is it around the 2% like the government has been saying?
Inflation in Japan non-existent. It's not bad at all. That's the whole problem. They want they want inflation. As you mentioned, they want a 2% inflation rate, just like Europe, just like the United States. Everybody's gunning for a 2% inflation rate just to keep some modicum of growth going on without overheating. But here, too, and I want people to remember this part, too, everybody has been wrong about the effect of central bank stimulus. Economists, stock market pundits, everybody's gotten it wrong. We were supposed to have hyperinflation by now in Europe, the United States, and Japan. We don't have it anywhere. In fact, just the opposite. They can't get even the minimal 2% inflation rate they want. So the yen has weakened dramatically against the dollar, but frankly, I don't know why, and I don't believe anybody knows why. The reasons that are most plausible that everybody who's smart is talking about is that the U.S. is getting ready to raise rates. Japan is keeping rates at zero. Japan is pumping more as a percentage of its economy, pumping more currency into the monetary system. So those factors should cheapen the yen as the dollar is going to get more appealing since yields are going to be going up in the States. Well, that's what people say is going on, and for whatever reason, the yen has weakened dramatically against the dollar. But there is no inflation in the United States or Europe or Japan. So I don't know, and I submit that nobody knows, which is something I want people to keep in mind when we talk about the 3% signal.
Okay, and before we go on to talk about your book, I want to talk, not related to investing, but the Fukushima that happened after the tsunami, that the nuclear power plant that collapsed in Japan. What effect did that have on Japan? And was the damage worse than what we thought? Because there's a lot of media publication out there how the disaster had polluted the Pacific Ocean water and etc.
Yes, those reports have been wildly exaggerated, as far as I can tell. Even during the meltdown itself, right after the tsunami, when we were radiation fears all over the place here, at that point I was monitoring with private Geiger counters and other radiation reading implements, and also government tools, because people said the government was lying. Even at that time, the radiation levels were not dangerous to people in the area ever. So all the stuff about us turning green and the fish floating belly up in the ocean and you know, babies being born with 3 arms, it was all wrong. None of that happened. Radiation levels where I am, which is about 100 miles away from ground zero of Fukushima, and in the Tokyo area, they were never dangerous, ever. It never got higher than what you experience when you have an x-ray at the hospital. So the whole thing was a bunch of hype and a media storm to get attention. These days, of course, there's a problem. The disaster really did happen, and there was leakage of radioactive water into the ocean, but it was never a significant enough amount to matter. And recently there was a report that there in America, the west coast of Canada and the United States, so North America, they detected radiation that could be traced back to the Fukushima plant. But even that report said these are tiny, tiny levels of, I think it was cesium, that was normal and didn't pose any threat to marine life or human beings using the ocean as we normally do. So I want to put all that out as backgrounder. Furthermore, there's been zero change in daily life here. Nobody has to wear special clothing. Nobody avoids going certain places. Now, of course, the Fukushima area itself, where the Daiichi power plant was and the town right around it, that's still evacuated. You can't go in there. But aside from the people that live there and work there, nobody ever did anyway. So it really isn't a big deal. And I know you don't hear that much because it's much more exciting to talk about how Japan's in a radioactive cloud and don't visit. But life is absolutely normal here, and the amounts of radiation that have been detected so far are low and just unthreatening to a normal way of life.
Yeah, the media had a thing about overhyping things, especially the liberal media that don't support nuclear energy. They take a chance, any chance they get, to try to show people the downside of nuclear energy. And there are downsides. One of them is radiation, of course, and if there's a natural disaster and the power plant get affected, this stuff can happen. It's true, but with the technology today, they could move it further inland, away from the ocean.
That's right. And I would like to add to that I am a big proponent of nuclear power, and I feel I have a nice platform to say that since I live so close to ground zero of Fukushima. What happened at Fukushima was not a failure of nuclear technology. It was a failure of politics in Japan because they located a non-tsunami resistant power plant within a tsunami inundation zone. If they had done one of two things differently, it would have been fine. They could have put a different type of power plant in the same location, one that is built to withstand tsunamis. Those exist. They could have put that type there, and it would have been fine. Or they could have taken the same kind of power plant they have there and moved it up into the mountains, and everything would have been fine that way too. The whole issue was because of political backslapping and just the usual payoff. Somebody knows somebody who knows the land and this and that. Because of that stuff, they put the wrong kind of plant in the wrong location. That's the only thing that went wrong. So it is not a black mark against nuclear power at all. It's a black mark against political corruption.
And that's an interesting insight. And yeah, it seems like government always screws things up. I mean, look at California and the drought that they're having right now. Excuse me, the water drought.
Yes.
It's a result of politics and government misallocation. So I want to talk about your book now, The 3% Signal. I almost finished reading the book. It's a great read. It's very different from other books I've read. So I want to talk about why did you decide to write this book? You wrote another book you mentioned earlier, The Neatest Little Guide to the Stock Market. So why did you decide to write The 3% Signal?
This is the book I knew people needed from all the feedback I received on my stock book, which showed me that people still weren't getting it, and they still thought that the way to succeed in the market is what they're always told by media. You buy something that's hot, you hold it till it goes up to a certain level, and then you somehow magically know it's time to sell, and you sell that one at a high, then you move on to another one at a low, and then sell that one at a high. Let me disabuse people of that fantasy. It almost never works. It exists only in theory because almost nobody can pull it off. This is why even professional money managers lose, the majority of them lose to the unmanaged index. So based on that, this idea that human beings do not beat the stock market, what can we do instead that will give people an edge over the long term in their retirement and other long-term investing accounts? This is that plan. This 3% signal brings together the only two parts of the market that people need in order to prosper over time, and it provides them with a quarterly, clear signal on what to do. This is important because most investment plans ignore the emotional needs of investors. This is why you'll see dollar cost averaging looked at in a vacuum as if people keep doing it through big crashes. They don't. They bail out at the bottom. You look at buy and hold plans as being the most profitable, and then if you just put $10,000 into this and hold it over your lifetime, we retire with this much money. Great, except people don't do that. They put their $10,000 in, it goes up to $15,000, it goes back to $14,000, they bail out, then they miss out as it would have gone up to $22,000 after that. This happens all the time with ordinary investors in the market. So this plan uses only a small cap stock fund and a general bond market fund, both of the index variety, extremely low cost, no human meddling involved. This is important because human beings have a 50% mistake rate in the market, whether professional or amateur. And when you apply a 50% mistake rate to any investment, even the highest flying stock, Apple or the Chinese market or whatever it is, whatever asset you're talking about, if you apply a 50% mistake rate to that, you'll greatly diminish the returns to below market level. So what the 3% signal plan does is it hides the complexity of the market from the investor and reduces it to just one set of quarterly prices, and that is the price of the stock fund. The only thing we want from that stock fund is 3% growth per quarter. Now, I hasten to add, this is not 3% growth of the whole portfolio religiously every quarter. No, it's using 3% growth in the stock fund as a signal line for rebalancing between the two funds. At the end of a quarter, investors look at that stock fund. If it has grown 3% exactly, they do nothing. That almost never happens. Instead, if it has exceeded 3% growth, let's say it went up 5%, they sell that excess and put the proceeds into the bond fund for safekeeping. If instead, or in a different quarter, the stock market comes in at less than 3% growth or loses money, then the investor uses capital from the bond fund to make up that difference to the 3% growth line. So the stock fund is rebalanced back to what it would have been if it had grown 3% in the quarter by either selling the excess and putting it in the bond fund or using the bond fund to buy the stock fund up to where it should be. This simple mechanism on a quarterly basis causes the investor to react intelligently to what the market already did. No forecasting at all required, which is good because nobody knows the future. Nobody. Not any of the famous pundits, nobody does. We all have a 50% mistake rate in aggregate over time. So this doesn't even try to predict the future. It just looks at what happened. If the stock market is weak, defined as less than 3% growth, you move more money into it. If the stock market is strong, defined as more than 3% growth, you take money out of it. That's it. This simple process nudges the performance of the portfolio higher than the markets over time in most time periods, not all, but most time periods. And another important aspect is not only does the math work to keep the performance above the markets over time, the emotions work. This is critical because getting a clear signal every quarter, that's not so much that it's bothersome to the investor, but not so little that the investor feels they've abandoned their portfolio. It's just enough to check in and kind of reset things, make sure everything's fine, and the person comes to trust the signal so that when you go into an extended sell-off like the dot-com crash or the subprime mortgage crash, these reassuring signals keep coming saying, we know what to do. This is just mathematics. Prices are lower now. Time to buy. And in fact, this is exactly how much to buy. The signal tells us that. The stock market fund is down a little, you buy a little. It's down a lot, you buy a lot. Even in the worst case scenario, which is you fully exhaust the bond fund, so you're 100% in that stock fund, the signals are still reassuring to say you're supposed to buy more, but you can't, so just stay right where you are. Getting that signal on a quarterly basis helps the psychology a lot. And this is very important and frequently ignored in investment literature. Everybody analyzes investing plans as if they're run by robots that have rational reactions at every step of the way. We are not that robot. We are human beings that make the wrong call half the time. And this plan is intended to mollify the impact of our 50% mistake rate while also using the best parts of what we know from market history to exceed the S&P 500's performance over long time periods.
And that's a problem nowadays with investors. They try to predict the future and make their investment based on that prediction. So they think technology bubble is happening now. Let me short the technology sector right now. Well,
right.
Like look at the oil market. Nobody saw the oil prices collapsing, and it went from $100 all the way down to $40, and nobody saw that coming. If you ask any of the oil experts, nobody saw that coming. So it's just hard to predict what's going to happen in the economy and the stock market, and people try to base their investment decision around that prediction. It's hard.
Yes, and I recommend people just stop doing it entirely. There's a great bit of background in the book about why we don't do well in the stock market. I want to emphasize that. I don't just toss it out there casually. The book goes into the studies that have shown why we are not good in the market and why we hit a 50% mistake rate, even with 6,000 aggregate forecasts from professional investors. And I was part of that group, so it's humbling that the group's overall score was a 48%. I can't remember, 47 or 48%, but it was actually under 50%. So actually worse than coin toss odds. It's important to understand why we're not good at this. The stock market does not follow clear patterns on a reliable basis. No matter what, despite what you've heard, the evidence is in. It doesn't. Just because it went up last June or went down last July doesn't mean it's going to do that again. And even if it's done something 66% of the time, it might not do it the next time. So there aren't enough reliable patterns to hone our intuition. That's how human beings learn. The reason we get better at cooking and carpentry and engineering and songwriting is that the rules don't change. The patterns are the same. The way eggs and sugar interact in the kitchen never changes. We can learn that and get better at it because we practice and our intuition improves with this constant set of inputs. There are no constant inputs in the stock market. Just now is the chance to go back to our earlier discussion. Look at how wrong everybody has been about the Japanese government bond market, inflation due to central bank stimulus, and now the new one you tossed in there, the price of oil. These are three large macroeconomic trends that everybody has gotten wrong. No, actually, not everybody. Some people have gotten it right. But the thing is, you don't know who's going to get it right this time or next time. Who got it right last time might get it wrong this time. Who's been dead wrong this time might get it right next time. These fluctuating factors give us nothing solid to hold on to. So we're left with just guessing, which is why it's reduced to a coin toss set of odds. This just doesn't work. And the main point is it's not worth the energy and time. Our intuition works in certain fields. Building a business, perhaps, whatever it is that we do, that's where we should focus. We should not waste our energy and time trying to second guess the future of the stock market because it is impossible to do. This book shows why, although it doesn't do the groundbreaking research. I just report the research. So many people have worked on this and shown why it is human beings are not good at predicting the future of the stock market. I just summarized those findings in order to make the case for why we need the 3% signal. But it's a good summary, and it brings people up to speed quickly so they believe in the reason they should follow this plan. And, I really hope it helps people do that, to focus their limited time on Earth and their limited energy in endeavors that can improve their intuition with time. The stock market is not that. It's a zero validity environment, a key term in the book coined by Daniel Kahneman, the Nobel Prize-winning behavioral psychologist. I call that Z-val. I reduced the zero validity environment to just Z-val to refer to the environment itself and also the people in it. I refer to these forecasters, the pundits in media saying, oil's going up, oil's going down, inflation's around the corner. These guys are all Z-vals, zero validity, can't be trusted. Our own intuition can't be trusted. It's important to react intelligently using mathematics alone.
Now, what did your research tell you about conventional investing methods such as dollar cost averaging? Do you think that works? Why and why not?
Yes, dollar cost averaging is a very good method. It was I would say the stock market's best practice until this method came along, the 3% signal. The reason DCA is good is it automates the process of lowering average cost over time. You just send in the same amount of money on a regular basis, whether monthly or quarterly, no matter what's happening. So if you keep the plan going, an enormous if that I want to come back to, if you keep the plan going during big sell-offs like 2008 and back in the dot-com bubble too, if you keep going during that, you'll end up buying shares on the cheap so that when the recovery finally happens, you greatly benefit from it. The problem with DCA, dollar cost averaging, is that there's no guidance to it. You just send more money no matter what, and we don't react well in that environment. We don't feel that we're taking any kind of intelligent action to just keep sending money no matter what's going on. So when you get into a major sell-off and people start talking like they did in 2007 and 2008, that the financial system itself is melting down, the wheels coming off the cart, going off the rails, whatever metaphor you want, when that message is everywhere in media, people stop their dollar cost averaging plans. And they take their money out and get to the sidelines, and they always talk about it as if it's a smart move, saying, I'm just going to get to the sidelines until things calm down a bit, and then I'll get back in. I just need to stop the losses for now. Well, that's the plan going off the rails. Because they never get back in at the right time, and suddenly 3-4 years have gone by. It never looked like the right time to get back in because, here's a tip, it never does. And so dollar cost averaging goes wrong that way. The mathematics of dollar cost averaging are great. They work very well, and in some time frames, it can actually beat the 3% signal. However, there are two enormous caveats here, and I want listeners to really pay attention to this. First of all, because one single strong stock market index, like a Russell 2000 or an S&P Mid-Cap 400, a concentrated stock index with 100% allocation is way too jumpy, and people can't take that volatility. So what they do is they diversify their dollar cost averaging plan over several different funds, maybe 5 or maybe 10, even more in many cases. Well, right there, they've guaranteed that they're going to lose to the market, because that kind of diversification into bonds and safe stocks and dividends and so on so far has always lost to the general market over longer time periods. So people don't focus their dollar cost averaging plan on the highest performing segments of the market because they can't handle the volatility. Then the second part is, now that they're diversified into a bunch of different funds, then they go into a crash and it feels like they're just sending in their small amount of money every month or every quarter, and they don't feel like they're taking significant enough action, so they end up bailing out at the bottom. So those are two big problems with dollar cost averaging. If a person ran a relentless, rational dollar cost averaging program into a 100% stock market allocation, they would do very well over the long term. However, almost nobody can handle it. And then I should add, even that 100% perfectly executed dollar cost averaging plan will lose to the 3% signal in most time frames, but not all. So dollar cost averaging is very good. It just has some problems with it that come from the human emotions that don't run it properly. And that's why I come back to 3-sig, that's the 3% signal. It takes most of the benefit of dollar cost averaging and then combines it with a new benefit, which is taking care of the human emotions so that the plan stays on track. An 80-20 allocation to stocks and bonds run with the signal does better than a 100% allocation to stocks with a DCA plan, which ends up not going the distance because people can't handle the volatility.
And that's the problem that a lot of Main Street investors have, is the discipline and the emotion behind investing. They seem to go off course every time something bad happens in the stock market. And I think for people out there, the 3% signals might be something that they should look into to help them with that.
Yes, I believe so. A lot of people are misunderstanding a couple parts of it. It's been attacked a bit in the media. A couple of things that they're getting wrong is assuming that 3% signal means it's the entire portfolio grows religiously at 3% per quarter. No, that's not what's going on. We just use a 3% growth goal in the stock fund to set a rebalancing line. So the whole thing's not going to grow at 3% per quarter necessarily because you're moving money between the bond and stock fund. So 3% refers to the line at which we're going to trigger a rebalance. The other thing is people say, well, it's possible to bottom this out and you need to add a lot more cash in order for the plan to work. No, the book shows that even if you never add additional cash when you exhaust your bond capital, the plan still comes out ahead of the market in most time periods. So running out of cash is not catastrophic. You just become a plain vanilla buy and hold investor with the added reassurance from the signals that you're supposed to stay in that fund until you start getting some sell signals later. That helps a lot. People pay too little attention to that very important part, which is the reassurance of the signals themselves. So I just want to point out that even if the plan exhausts its bond fund, it's not over. It just keeps going with 100% allocation to stocks for a while until it gets the signal to move back into bonds. But if a person does have money outside the plan that they can use to follow those signals, what I call a bottom buying account, then the plan signals superb times to add extra money to the stock market. That's all it's doing. It's not a requirement. The plan works fine without that extra money. But if a person has that extra money, following the signals to put it to work in the market has so far been a very good decision.
Well, Jason, I'd like to thank you for coming on for Wall Street for Main Street podcast. Your book is a good read, very different from what I read before, and I recommend it to all of our listeners out there that's looking for another way to invest. So if people want to buy the book, where can they go?
It's everywhere books are sold, so Amazon.com, just search on the 3% signal. If you want to read more about it and get free spreadsheets, read stories of people who are using it and such, please visit my website, which is jasonkelly.com.
Okay, great. Well, Jason, thank you for coming on, and hopefully you can come on again soon.
Yes, I hope so too. Thank you, Mo.